I, of course, always like to start off the show with just a little commentary about what I saw happening so far this week in the stock market, and I'll share with you kind of the chart here. So this is the S&P 500 year to date. And you can see here what's happened in the last couple of days, including today. Market fell out of this range. We were in this range for 8 trading days in a row. If you look at that closely, you can see we were kind of bumping up against the top. But really, everything was revolving around waiting for the number coming out for the inflation, the consumer price index. And it came out this morning, and you can see what happened. The market dropped right away this morning and is kind of heading downward. And the reason is because the inflation was higher than expected. We take a look at that number here. So this is the index for year over year for the last 12 months. So we were at 8.6% increase in prices on this May versus last May. And you can see what happened here is we actually hit a high in March at 8.5, and then we dropped down to 8.3 in April, and there was some hope that we'd continue to come down, and then the Federal Reserve might be able to do something different in September. So they've already announced, and it seems to be pretty much baked in, that we'd have a half a point increase in June, half a point increase in July. They don't have an August meeting, so September maybe would be more reasonable. But with these higher inflationary numbers, now people are talking about the possibility of a higher increase, maybe another half a point in September. They do meet next week, so we'll find out more when they are interviewed and they talk about what their thoughts are. They've been pretty clear about broadcasting what they see as far as that goes. So one thing that's very fascinating, though, if you take out food and energy, what they call core inflation, and this is a particular basket that the Federal Reserve does look at pretty heavily, mainly because they feel like this is something they have more control over. Saudi Arabia and Russia, et cetera, might have more control over energy prices than the Federal Reserve does. So they look at these other pieces that are in there. That's actually been coming down. It did peak out in March. And so maybe that helps as far as what the Federal Reserve might be looking at here as that goes. The big thing we're probably going to be talking about a lot here is really gas prices. We're here, you can see this chart at nearly $5 a gallon, nationwide. I live here in Silicon Valley. We haven't seen $5 a gallon in a long time. Would love to see that. But nonetheless, the price is going up. You can see there was a big jump really in February when the invasion of Ukraine happened. And so this is something that's not going to probably get better for a while, just because we have Europe pulling off of Russian oil, Russian natural gas, and Russian coal. And so that's going to make them have to go out and find, these resources in a very tight market already. And so that creates all kinds of issues as far as that goes. But 4th of July is normally the peak for gas prices. I'd be a little bit surprised if that happened this year. I think it could actually keep going for a while. But, we are in a seasonal time frame where gas prices do go up also. So that's impacting pretty heavily, the inflation numbers that we're seeing as far as that goes. So that's what's going on in the inflation arena. It's a big deal. It's the thing that we're all talking about and looking at and trying to figure out how this might slow down in some format and what the Federal Reserve has to do in order to get this under control. Of course, the big concern is the Federal Reserve will have to tighten up the money supply and basically raise rates by such a high percentage that it could kick us into a recession. So, that's what we're all kind of walking this tightrope to see what happens. I'll show you a couple things that are kind of interesting. This is a 2-year chart of the S&P 500. So you can see we had this pretty phenomenal run up. And then obviously as of the beginning of this year, we've had this kind of jagged downward motion. This big green blob, that's over my head here, is what's called a volume profile. This is a really cool concept. What we're looking at here is every one of these bars shows how many shares were purchased at that price. So when the bar comes over farther, and there's a bigger bar, that means there's more purchases at that price. And so if we look, for example, right there is a lot of overhead resistance. And you can see that 8 days that we spent was right under that. And what happens is, let's say somebody buys a stock at $10, it drops to $8. When it gets back to 10, they might take their money back. Hey, I got my money back. So they call that resistance. And so we dropped down below and then tried to get back up. We could not get through that resistance and eventually broke down. But now we actually have support. And so again, this is an area where a lot of people bought shares. It did jump up, right? And so they say, okay, I bought it at 10. It went to 12. I was pretty excited. If it gets back to 10 again, I'm going to buy, right? So that's what's called support. And so we dropped right down to the support level that we have here, today, this morning. But one of the things to consider here is there's not a tremendous amount of support under that. One of the disadvantages of running straight up, like you see here, is that you didn't spend much time at any one price. And so oftentimes that means you can kind of cascade, once you get through that. So this is going to be very important to watch this support level right now to see what's happening. This is the S&P 500 as presented by the Spider ETF. And so, it's not the be-all to end-all to look at support and resistance, but it's a very active ETF with a lot of volume. So it's a great one to look at, in my opinion, but just to clarify what this is. So anyway, that's what's happening here in terms of support and resistance. And the other thing that we're really watching for is the possibility of recession. I talked about last week pretty succinctly, the three big indicators that I'm watching. The 3-month versus the 10-year Treasury yield spread, and the leading economic indicators from the Conference Board, and the ClearBridge economic indicators, all of which right now are showing no recession in the next 12 months, but that can change. And so what I'm showing you here is the rate on the 3-year Treasury bill. You can see it's going up quite nicely, really, very much so. This should help your bank accounts and your savings accounts and those types of things should start paying more. CDs, short-term CDs should start paying more. We're up to 1.33%, but if you look at that pattern, it's pretty straight up. And then if we compare that to the 10-year Treasury, you can see the 10-year Treasury is going up recently, but not quite as smoothly and as fast as the 3-month. And so what they call the spread is the difference between the 3-month and the 10-year. And what we really want to watch for is if all of a sudden the 3-month starts paying more than the 10-year. The bond market has been very accurate historically at predicting recessions. Essentially what they're saying is that they're not willing to pay as much on a 10-year because the future doesn't look bright, right? When the 10-year is a lot higher than the 3-month, we're expecting growth. And when we see that opposite happen, what they call an inversion, we're expecting contraction, which would be a recession. So pretty far away. You got 3.15 versus 133. Pretty big spread between them, but you can see the pattern. There's a little bit of consolidation recently, so we'll see how this plays out also. So, that's what's happening in total. I think it's something we just got to keep watching and see what's going to happen here. Watch this support level. It's a time to be a little bit cautious, as far as that goes. We're not probably looking at significantly lower inflation during the summer. That's usually a higher inflationary time period. So we might not see relief on that CPI number until the fall. And so we'll have to see how the market plays that out as far as that goes. So nonetheless, that's what's going on this week so far, and look forward to being able to talk to you again next week about it.